And we go to London. It's over for South Africa. We go to London and speak to the chairman of Intellidex, and that's Stuart Theobald. And we're going to continue the theme that we had in business tonight, i.e. the listings on the JSE, and get Stuart Theobald's picks for 2014. Out of those listings, 22 of which there were, apparently, according to Donna, our previous guest. Stuart, yeah, 22, not quite as ebullient as some other markets, notably the United States, but still a fair number. Any of them any good?
Well, I guess the answer is we have to wait and see. It's early days for most of them. They've got to show us a track record, show that they can go into the listing environment and really take advantage of it to deliver returns to shareholders. But there are some pretty old businesses among them, so we do have quite a lot to work with from a numbers point of view with some of them. Some of them, of course, are brand new. We really have to kind of wait and see. So we've dug through them. Some of them we think are overpriced. Some of them are pretty so-so, and a couple of them represent value in our view.
Stuart, it's Nozipo in Johannesburg. Let's get your top 3 picks that stood out for you in 2014 that you would recommend as buys or at least a hold.
Well, we think that the stock that we find most attractive out of the new listings is PSG Consult. Our viewers might know of the PSG group, and this is one of the businesses that has spun out of it. PSG has a long history of spinning out good businesses that turn out to be real winners for shareholders. One thinks of the likes of Capitec and some others. And this, we think, is one that could be another winner along the same lines. PSG Consult is really a large brokerage network that sells financial services to its clients, financial advice and related policies. We've looked at the metrics. It's showing some really good growth numbers in the last few years. It's looking like it has some good targets, and it's not overpriced. You know, it's trading at around a 21 PE. Now, it's new to the market, but it actually does have a trading history because the shares in PSG Consult used to trade over the counter. That's in the off-market, unlisted environment, and shareholders who got involved in that early have done pretty well. It's one of those 10 baggers that's gone up about 10-fold. Now, we're certainly not expecting that kind of performance again, but we're expecting some upside. We think there's a good 30% value in it from where it's currently trading, so that's one of our picks. Beyond that, Alexander Forbes is the giant of the new listeds on the market. That used to be on the market and was delisted by a consortium of private equity owners. It's been through a major kind of restructuring exercise, improving efficiencies, really refining its market proposition, and now it's back on the market. Now, while it was off market, we were big fans because you could actually get exposure to the stock because there was a strange listed vehicle that allowed you to buy into a mix of pref shares that we knew were going to convert at some point in the ordinaries, and we were saying, well, it's a good idea to buy those and just wait around for the conversion to happen. And shareholders who did that are smiling because they managed to pick up the stocks that are now listed at a pretty good discount. It's up probably about 15 or 10% from where it initially traded on listing. It's at a very rich PE, above 40, that we think is quite demanding. We think it's a very solid business. It's got a good, solid annuity revenue base, so low-risk business model. But to meet those kind of growth expectations is going to take some work. We think it's largely going to happen out of expansion into Africa, where there's more opportunity than there is really in its home market of South Africa. But we think it's a good, solid business, so one to hold on to, even though the growth numbers look further off. You're asking me for 3. If I had to go for a third one, I'd choose Rhodes Food Group. Completely different business, but it's also a business that's been with us for ages. It's over 100 years old or something. It's known as one of its brands is Bully Beef, and it's in food canneries been a good Western Cape-based business for many years, and really it's showing some really good growth numbers. We saw it list, and its first set of numbers gave us earnings growth of over 40%. That's driven a big surge in the share price in the last kind of 6 weeks or so since it joined the market. But we think there's a bit of upside there as well, particularly if we see any weakness among them. So that's 3 if I had to choose among that spate of new listings.
Hi, Stuart, it's Viv here. I mean, as you mentioned, the 3 stocks you've chosen have either been, you know, quasi-listed or incredibly old companies that you have quite a bit of detailed information on. For a retail investor out there, what advice would you give them when looking at a listing that's, you know, for a newer company? You know, should they just avoid them entirely, or what kind of procedure should they go to basically, you know, before they decide to buy into an IPO for a more, you know, a less well-known company, or a company that doesn't have a quasi-listing or a, you know, of such a long history?
Yeah, it's a good question, and it's not very easy. You know, when you approach these companies, you don't have that track record, and the main problem with not having a track record is you're not sure just how reliable the promises of management are. You know, when you've had a company that's been listed for a while, you can look at what management say, and then you can compare it to what actually happens over time. Here, all we have is a set of promises when you have a company that doesn't have that track record, and we've got to make a judgment call on whether we're going to trust those promises or not. I think there are fundamentals about a business that can tell you how reliable the promises are. So what kind of growth promises are they making? Does it really depend on sort of outlandish assumptions about what's going to happen in the market? What kind of base value is there in a business? So look at the net asset value. How much equity is sitting on that balance sheet, of real tangible value that shareholders can count on? You need to look at within the mix of assets, what sort of quality is there? Is there good tangible assets like cash and so on? Or are you just really relying on a balance sheet that's cobbled together out of various acquisitions that is yet to actually get on its feet and operate as a coherent business in a listed environment? That's where things are much more risky, and you shouldn't really rely, or you should be much more cautious about the promises.
It's always lovely to have you. A very big thank you to Stuart Theobald. He is the chairman, of course, of Intellidex.